One of the biggest factors to getting approved for a mortgage loan is having an acceptable debt-to-income ratio. And chances are, you're calculating it wrong. Like, really wrong. In this video, we'll talk about how to calculate it, what's included in it, and what's not included in it. After the crash, documenting and calculating debt-to-income ratio became a huge focus on regulators when they went to revamp the mortgage process and mortgage guidelines. For a lot of people, you calculate your debt-to-income ratio by taking your minimum monthly payments for all of your debt and dividing it by your gross monthly income. But there are some things that aren't on your credit report and isn't included in your debt load that we'll go over in a little bit. First and foremost, if you're a W-2 employee, your income will be based off of your gross income, meaning before any deductions for medical expenses, 401k retirement plan contributions, any taxes you withhold. And that's one of the first mistakes I see when people go to calculate their debt to income ratio. They go by the net income, meaning the income that they bring home. Now, if you're hourly or salary, it can be pretty easy to calculate your income. Where it gets tricky is if you have bonus, overtime, commissions, or any kind of variable income like that. If you do have that variable income, there's a good chance that you're going to need a 2-year history to be able to use that income. For example, let's say that you have a salary of $60,000, but you are started to get a bonus the last 3 months of $1,000 a month. Because that bonus is fairly new, you've only gotten it for 3 months, you won't be able to count that bonus income, but you'll be able to get qualified off of your salary. Let's say you do have a 2-year history of commissions or bonus or overtime. It's going to be a 2-year average of that income. For example, let's say you had $10,000 worth of overtime 1 year and $12,000 worth of overtime the next year. You're going to average those two numbers together to get your $11,000 worth of income over 2 years. And that's what you'll be able to get qualified off of in addition to your salary. Now let's say you're self-employed, meaning you own your own business or you get a 1099, you're an independent contractor. Most likely you're going to need a 2-year history in that role to be able to count that income. It's important to understand that when you're self-employed, it is extremely hard to calculate your income. A lot of times your income is actually going to be closer to what you have on your taxes after a lot of your deductions and write-offs. There are some things that lenders can add back into your income, but to be safe, always get with a mortgage lender and provide the documentation that they're requesting so that you can get your income calculated very quickly. Really, it's a good rule of thumb that if you have any kind of variable income or anything other than very standard hourly or salary employment, to get income documents that your lender needs, get that to them as fast as possible so that they can calculate the income so that there's no surprises down the road and you don't waste any of your time or money. All right, we've gone over income, so let's go over some things that are not included in your debt to income ratio. Number 1, car insurance. That does not need to be included in your debt to income ratio calculation. Number 2, health insurance. Number 3, any deductions you have on your pay stubs that go to retirement or any contributions that you make to your retirement. Number 4, utility bills. And number 5, loans that you have against your retirement account. Oftentimes you'll see people take out a loan against their 401k, their IRA, in order to come up with a down payment and closing costs to buy a house. Okay, so generally speaking, lenders go by the minimum monthly payment that is reported on your credit report for all of your debt. So with most liabilities, it's less about what you owe in total and more about what you have to pay monthly. For example, let's say you owe $10,000 on a credit card. Now that may seem detrimental to some people that have a lower income, but it's only going to go by the minimum monthly payment that you have to make. That minimum monthly payment may only be $100 depending on your setup with your card. Same thing with like car loans. So let's say you owe $20,000 on a car, but your payment is $350 a month. It's less about the $20,000 balance and more about the $350 per month. Now there are some things that are not on your credit report and won't be reported on your credit report that do have to be added into your debt to income ratio. Here are some of the common ones. Number 1, alimony or child support, specifically ones that are court ordered, not voluntary. Number 2, tax repayment plans. So if you have a repayment plan set up with the IRS because you owe some back federal taxes, that will have to be included in all likelihood. Number 3, housing expenses. So even if you own another house, that mortgage and any taxes, insurance, and HOA dues will need to be counted in your debt to income ratio, assuming you're not selling that house before you buy another. It's also important to understand that even if you own that house free and clear, you still have to count any taxes, insurance, and HOA dues that are associated with that property. Number 4, private mortgages. This includes owner finance, any other type of private mortgages that are not included on your credit report. Those need to be included in your debt to income ratio as well. Number 5, payment for your student loans. Now this one gets a little tricky, so we'll go over some different scenarios. With most products, if your mortgage lender pulls your credit and there's a payment reported on your student loans, then that's what they'll have to use to qualify you. A lot of times when your mortgage lender pulls your credit, the payment on your student loans will be reported as zero. If it's reported as zero payment, then the lender will take the total loan balance and use a percentage of that total loan balance to calculate your minimum monthly payment. With FHA and Freddie Mac, you'll use 0.5% of whatever your total loan balance is and calculate that as your minimum monthly payment. So a $10,000 total loan balance would equal a $50 monthly payment. VA is a little different. You'll take 5% of the total loan balance and then divide that by 12 to come up with your monthly payment. A lot of times with Fannie Mae, you'll have to use 1% of what the total loan balance is. So a $10,000 loan balance would equal a $100 monthly payment. All right, let's use a real world example to drive the point home. Let's say you make $10,000 a month gross. No overtime, no bonuses, no commissions, just a flat $10,000 per month. Let's say you've got a $20,000 car loan that's $300 a month. You've got $50,000 worth of student loans that are in deferment, and you've got a $5,000 credit card where the minimum monthly payment is $75. And let's say you're borrowing $300,000 at 3.5%. If it's a 30-year loan, then your principal and interest payment would be $1,347.13. Let's say taxes and insurance for this house, the taxes are $3,600 a year, which would be $300 a month, and the insurance is $2,400 a year, which would be $200 a month. That would make your total mortgage payment $1,847.13. In this scenario, let's say that there are HOA dues of $100 monthly. So if we add up all those minimum payments, $300 for a car, $75 for the credit card, 0.5% of $50,000 for your student loans would be $250 monthly. And then you add in the total mortgage of $1,847.13 and your HOA dues of $100 per month. If you add that all together, you get $2,572.13. That is your total monthly debt load. If you divide that by your gross monthly income of $10,000, you get 25.72%. 25.72% is a pretty good debt to income ratio. Keep in mind this was a very, very easy situation. The best way for you to figure out your debt to income ratio is for you to talk to a licensed mortgage loan officer. If you've got any questions or something wasn't clear, feel free to ask questions in the comment section. Also, if you have any ideas for future videos, I'd love for you to drop those in the comments as well. Thanks so much for watching. If y'all made it this far in the video, y'all the real MVP, and we'll see y'all next time.